The S&P hit a record high on Tuesday, extending Monday's rally as investors looked ahead to a potential rate cut from the Fed. Expectations of easier monetary policy helped to lift the market even as phase one of the U.S.-China trade deal may not be finalized in Chile, sinking the market into the close. FactSet data showed that 78% of the S&P 500 companies that have reported so far have beat analyst expectations. But could it be that the expectations were just set too low? Are current valuations justified for businesses just being less bad? Investors are now struggling to find new reasons to buy and extend the new record rally in equities, and analysts point out that the big risk is that we're seeing a boost to asset prices, but no real uptick in the real economy. So for more on this, we're now joined by Peter Schiff, CEO of the Euro-Pacific Capital. So Peter, phase one deal just hyped up this entire bull rally. And this is just an interim deal that basically just kicks the trade can worries down the road and delays action. The U.S. is actually hedging themselves right now as Treasury Secretary Mnuchin is still not giving a definitive answer on whether or not the December 15th tariff will be taken off the table. So if phase one is this hard to nail down, how bad will phase two be?
Well, I don't know if there's ever going to be a phase two. I think phase one is simply a way for Trump to save face and to surrender in the trade war, but still claim victory.
And Peter, we're talking about the Federal Reserve cutting rates yet again, even while the market is breaking out to new record highs. We saw this record close yesterday on the S&P 500, but this is the third rate cut here we're talking about. You know, we've been over this before, and you pretty thoroughly demolished their arguments for it. But what are they saying now to justify this third cut when stocks are hovering near a 15-month high?
Well, we'll see how they walk that tightrope. You know, they're trying to pretend that these rate cuts are just some kind of mid-course correction, some kind of insurance policy. But if you remember, a year ago at this time, not only was the Fed raising rates, but they had forecasts that they would continue to raise rates throughout 2019. I was the only one out there saying that they weren't going to do that they were going to be cutting rates, not raising them. But more than that, it's not just that they're cutting rates, they're back to quantitative easing. They have called off quantitative tightening, reverse course. They're doing quantitative easing, except they're not admitting that that's what they're doing because they're embarrassed to have to acknowledge this. But if you actually look at how rapidly the Fed's balance sheet is growing now, it's actually growing faster when they're not doing QE than when they were.
So right now, as you mentioned, the Fed's balance sheet is basically exploding. They're doing $60 billion a month on QE. They're injecting $130 daily every single night on daily repos. Why is the Fed injecting so much liquidity into the system when they still claim that nothing is wrong? And right now we're expecting a very hawkish rate cut tomorrow.
Yeah, just ignore what they say and look at what they do. Look, they are trying desperately to keep the air from coming out of this bubble. But it's not going to work. I mean, the bubble has already popped. The only question is how fast is that air going to come out, and when is the market going to figure out that the game is over and understand what the Fed has been doing and understand the true nature of this bubble economy and what's going to happen in the future.
There certainly are a lot of bubbles. Google actually just reported, and while they beat on revenues, they missed on EPS. So this was partially, they claim, due to lower margins, now that their margins have been shrinking for several quarters. So is this concerning? And given these diminishing returns, is Google still considered a high-growth stock play or no?
Well, look, all of these stocks, Google included, are dramatically overvalued. You know, because of the Fed, because of the monetary policy that we've pursued, we have inflated asset prices like stocks and like real estate. Now, there are a lot of companies that aren't worth anything. There are a lot of these companies that are losing money that have high market values because of the Fed. Now, Google at least makes a profit. But in today's interest rate environment, the present value of those profits has been inflated by the Fed. What the Fed is trying to do is prevent those asset prices from coming back down to earth. But for a healthy economic recovery, that's what we need. We can't continue to have overpriced assets. You know, Donald Trump put out a tweet today in which he's envious of the Europeans and the Japanese because they have negative rates. And he says, this is great. You know, they get to borrow They get to be paid to borrow. Why can't Americans get paid to borrow? What Trump is overlooking is who is paying the bill, who is stuck with the cost. It's the savers that should be getting paid by the borrowers who are borrowing money. It's the citizens who are going to end up losing because they're financing these loans. But all of this is producing malinvestment. It's helping to expand government at the expense of the real economy.
And Peter, just to play devil's advocate for a minute here, looking at one indicator in the U.S. economy, consumer confidence, it dipped in October in the latest survey. And there's also good reason to believe that this phase one trade deal is a lot of hype and may very well still not happen. So is there an argument that the Fed, this third rate cut, is a prudent measure to ensure against the loss of confidence in the event that this trade deal doesn't go through?
Look, the one thing the rate cut is not is prudent. It's a desperate attempt, again, to keep the air from coming out of the bubble, to maintain false consumer confidence. You know, consumers are confident despite the fact that the economy is a disaster. They don't have any money. They have lousy jobs. They have no savings. They're loaded up with debt. But as long as they can keep on borrowing money to buy stuff they can't afford with money they don't have, for some reason, they remain optimistic. And you have all of this, hype coming out of Wall Street, coming out of the media to try to encourage all of this false optimism. The Fed plays into that. I mean, the Fed keeps talking about how the economy is in a great place, even as they've got it on life support. So eventually the consumer is going to figure out just how bad the economy is. Unfortunately, it's going to be too late for him to do anything about it, and he's going to be blindsided. But I think it's the investors who are in for an even more painful awakening.